Hey, today we're going to talk about diversification. Should you be diversified in your portfolio? You might be surprised at my answer and my take on this. We're going to discuss about all that after the intro.
Hey, yeah, it's all about wealth engineering. Might be something that you're not used to. It's okay, cause I'm here to introduce you to concepts. Time to grow and make big moves. All about crypto, come see. Stocks and business, yes indeed. Got the info that you need. Hosted by my homie JC. Hey, yeah, wealth engineering. Stacking and stacking it up. It's time to generate wealth. Till you living like Scrooge McDuck. Hey, wealth engineering. It's time to show you the game. Till you living like Richie Rich. Till you ballin' like Bruce Wayne. Hey, you ain't gotta be an expert, no problem. It don't really matter where you at, just start it. It'll take time, hard work, and
What's up? What's up, guys? This is JC, and welcome to the Wealth Engineering Podcast. If you're new here, my name is JC. I create content to help millennials and motivate them to increase their net worth, retire early, and build generational wealth. I have a huge passion for investments, and I have a background in engineering. So together, I mix them together, and I create wealth engineering. And how do we achieve that, guys? We achieve that by investing in stocks, crypto, real estate, and business. And if this is something that interests you, I want you to make sure you have the subscribe button. Click, like, subscribe, and click the bell. And we're constantly creating content, guys, to motivate you and encourage you to increase your wealth, retire early, and all that. So I definitely wanted to say that hey, today we're going to have an interesting topic. Part of building your portfolio is going to have to evaluate that eventually. Should you be diversified or not? We're going to be talking about all that, but make sure you also send this link to as many people as possible because these are the conversation that we need to start having in our community with people that we know about, right? We are not being taught these information at school, or these are valuable information that we need to know about. And this is the type of things that, hey, if you're in your 20s, if you're in your 30s, especially if you're in your 30s and 40s, you need to start thinking about your portfolio for retirement. And I often say it, guys. I often say it, hey, you never know. In the next 10, 20 years, you never know what's going to happen. We might be seeing a lot of changes in the job market with technology, with AI and all that. So make sure you have your portfolio that your portfolio can take care of you instead of having the machines replacing you guys. So this is something as an engineer, I always think of the future. I see how technology could affect the world. So I often think about, guys. I often think about that. But what are we going to talk about today, guys? We're going to talk about a lot of things. So I have a couple videos ready for you guys that we're going to react together. I actually didn't even share my screen yet, but we're going to react to these videos together, and that's going to show you two different perspectives when it comes to diversification. And I actually went in there and found some of the videos of the people out there that are authorities in this niche, right? That have a lot of weight. Their words have a lot of weight. And we're going to evaluate two different aspects of this topic and go from there. All right. So that we're going to have three videos that we're going to react to. And I'm going to give you my perspective as we're reacting to these videos. I'm also going to share you my story, guys. A story that the first time I actually realized the importance or how diversification was affecting my wealth, right? That's the main thing I wanted to share about you. So I'm going to share with you my own stories and what you can learn from that. And I'm also going to talk to you about different things. If you're really interested in diversification, we'll talk about the best timing for it, the best strategy for it as well, and only as an information and educational purpose only. I'm not a financial advisor. This is not financial advice. But before we dive deep, guys, before we dive deep in all that, very interesting show. I'm very excited to do it. We gotta also pay tribute to the chat. I also have to say salute to my wealth engineers, and let's get into it. So I see Mr. Real Estate was early on. Shout out to you, sir, and thank you, J Bones, for being basically, so far, the sponsor of the stream. Thank you very much for your contribution. Shout out to you for the super sticker, J Bones, a true supporter. Thank you again. Hey, how are you doing, Malika? How are you doing? Hello, hello. Saying hello, all. Let me see. Good evening, big bro. Just saying hello, heading to the airport. We'll catch you later. Absolutely no worries. And I wish you have a safe trip. Connect with us if possible when you get there. But I love to see you on the comment, even on a replay as well. So replay gang, salute to you. Let me see. Please hit the like button as you come in. Make sure you hit the like button so that as many people can see the stream as possible. I try to make it at exactly at 8 p.m. today, but I was running a bit late. I was with my family, my mom and dad earlier, and I was rushing to make it on time. But I had to make time to spend it to you guys because you're also my family, my wealth engineers, and I have to make sure that we're going to make this stream. So please share that to as many people as possible so that they can get this information as well, right? I know there is football out there is basketball out there, but we got to start thinking about our portfolio because that's how we're going to have the money to go spend on those football and basketball or whatever your passion is. So please help me share and reach as many people as possible. How are you doing, Afro Mix family? How are you doing? Hello there. I'm doing good. I hope you are doing good as well. Yes, with them eyes. I think the eyes might do an appearance tonight. We might have an appearance with them eyes tonight. So shout out to you, J Bones. This is the first time we're attending your live stream. Oh, we. So that means you and your I believe your husband, yeah, maybe, or your boyfriend. I'm not sure. Maybe you could clarify that. But hey, thank you very much. Thank you very much for your support, and hopefully I can keep it as entertaining as possible for you too. But thank you very much. Let me see. DJ Flip, how are you doing, sir? Salute my wealth engineer. There you go. We play game indeed. Always check. Yes, yes, absolutely, absolutely, guys. All right. So let's get into the topic, guys. Again, shout out to the sponsor of the string so far, J Bones. I always say, hey, whoever is super chatting the most is the current sponsor of the stream. And if we close the stream like that, then you are the sponsor. But I have many video guys for you. We're going to, and I think again, we're going to provide two different perspectives. Should you be diversified? Yes, no, and why? Right? I'm going to provide you. I think there is a lot more to learn if you could listen to different perspective and then make up your own mind. And I think that's the idea that I'm trying to create in this stream. That's what I'm trying to bring you guys. I don't want to tell you, hey, this is what you should do, this is what you shouldn't do. No, I want you to go over it and start thinking about it in a way that you can make the best decision for yourself depending on your situation, because only you know your situation. No one else knows it better than you, right? And you sometimes you have to factor a lot of aspects when it comes to making a decision like that, right? When you make an investment, you are investing for your future, correct? You're investing for your own future. So you need to be aware of how you're going to address and strategize your portfolio to get the best out of it for your own future. So these are important questions that you're going to need to ask yourself. And that's why we're going to make this. So let me connect the video that I had for you. All right, all right. There you go. We're going to do it like this, or yeah, we could do it like that too. All right, so I'm going to play that video, guys, and I'll stop it because I have to stop it at some point. Otherwise, it just becomes a copyright issue. So I have to stop it here and there. But I'm going to stop it to provide my own insight as well. And that's going to help me go set the stage for this conversation tonight. All right. So for those who may not know, this is a young, I mean, young, right? He looks old here, but relatively speaking, this is still young compared to what he looks like now. This is Warren Buffett, one of the greatest investors in the 20th century. Okay. And we're going to hear his perspective on diversification, right? And again, why does his word matter? Because his words matters because again, he's one of the greatest investors in the 21st century. All right. So it's not a random, it's not anyone. It's not like a guru, online guru speaking here. This is someone who has experience, and you have to value their experience sometimes when you make your decision. Shout out to you, Paris Johnson. Salute to you. Thank you for joining here just in time as we're about to explore different perspectives. From first, we'll hear Warren Buffett, and then later I'll talk to you about someone else. But let's get into it, guys.
Policies on diversification and also how you concentrate your investments. And I've studied your annual reports going back a good number of years, and there's been years where you had a lot of stocks in your marketable.
So, how is the audio right now, guys? Is the audio okay? Let me put a one in the chat if the audio, like the video audio, is that okay, or is do you need me to increase the volume or anything? Let me know in the chat. Hey, shout out to you, Need Watches. It's perfect, perfect. All right, all right. So okay, so let's get into it, guys. And again, sorry if I have to pause it every so often because I have to react to it too, so that I transform the nature of this video instead of just play it through. But sorry about that I have to pause it every so often. But hey, there's something, guys, I want you to catch because I let the question play for a reason. The question itself isn't very important. There's a lot you can learn just from the question alone. So I'm going to rewind it back, and then we're going to try to listen to that question again. Let me see.
Equitable, and there's been years where your annual reports going back a good number of years, and there's been years where you had a lot of stocks in your marketable equitable securities portfolio, and there was one year where you only had three in 1987. So I have two questions. Given the number of stocks that you have in the portfolio now, what does that imply about your view of the market in terms of, is it fairly valued, that kind of idea? And second of all,
All right. So, in case you didn't catch it, whoever is asking this question said, hey, there was one year you had considerably amount of stocks, and then there's another year you only had three stocks, right? So, although he's going to provide his own basically a perception about diversification, you can, even though that he's going to, and we'll listen to what his perspective is, but I want you to understand the question itself. He is applying two different strategies, and that depends on the market, because that's basically what the question was asking. Were you doing that because of the market, right? So a very interesting point. I want you to catch that, because we can elaborate on that further.
whenever it seems that whenever you take a new investment, you never take less than about 5% and never more than about 10% of the total portfolio with that new position. And I wanted to see if I'm correct about that.
Yeah, well, on the second point, that really isn't correct. We have positions which you don't even see because we only listed the ones above 600 million in the last report, and obviously those are all smaller positions. Sometimes that's because they're smaller companies and we couldn't get that much money in. Sometimes it's because the prices moved up after we bought them. And sometimes it's because we may be selling the.
Imagine having 600 million as a position, just one position in your portfolio. This is crazy, man. This is playing the game in a whole nother level, man. When are we going to get there, right? When are we going to engineer our wealth to this level? Crazy, man. But hey, let's get into it.
Position down even. But so there's nothing magic. We like to put a lot of money in things that we feel strongly about. And that gets back to the diversification question. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market. You own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses,
I mean, guys, I mean, I don't know if you heard it, but it's that was pretty strong statement, right? When it comes to diversification, because what is the common like what are most people are saying, right? Most people are saying diversify, diversify, diversify. You should be diversified, right? That's what most people are saying. Wow, before we go any further, shout out to you, Mr. Peter Investor M. Thank you for being my first member. I didn't even talk about it yet. I actually wanted to talk about it later in the stream, but you figured out that hey, basically set up a membership program. So if you want, guys, you can instead of super chatting every so often, you can actually one of the ways you can support the channel is by being a member. And man, not only you were my first contributor, the first super chat I've ever received, as the first super that I received basically before I was monetized was from Peter Investor M, but also the first person to join my membership is also you. Shout out to you, sir. Shout out to you. Really appreciate it. And welcome to the Wealth Engineering family. And happy to have you, sir. Happy to have you. I'll have to check later because I can't see it. I can't see which one you got, but whichever it is, I'm very happy for it, and thank you for your support. I'm happy also to see how it shows up here. I can see your name, so your name shows up differently, so that will help me a lot with understanding your comments because I never seen that before on the back end. So I'm very happy someone tried it so that I can understand how it works. But yeah, it shows differently, guys. It shows differently. So members are like almost royalty, and then the super chats are royalty too. So shout out to everyone who super chatted, and thank you, Peter Investor M, for joining as a member. But yeah, guys, yeah, going back to the content. What are if you don't know about investing and you were starting investing, most people will tell you you should diversify. You don't diversify, right? Make sure you don't they will say, hey, don't lose money. It's investing is you should not lose money, right? If you don't want to lose money, you should probably diversify because if one of your investment, fail, drops down, then at least your other ones, right? Your other ones are still here. So you should diversify. But Mr. Warren Buffett here, right? Mr. One of the greatest investor of our time in the 20th century, with 21st is still disputable, right? I think Cathy Wood is making a good case that she might win that spot for at least for the first half of the century. But the 20th century, Mr. Warren Buffett cemented that label as the best, probably, yeah, the best, the GOAT, the best investor of the 20th century. All right. But yeah, Mr. the best investor of the 20th century is saying, look, he's saying it in a nice way, but what he's basically saying is diversification is for idiots. Diversification is for idiots. That's what he's saying. He's saying that, hey, diversification is a good protection for ignorance. These are strong statements. And he's saying it as polite as possible, but he's trying to be as blunt as possible as well. So that's his view about it. So let's figure out why. Maybe he can provide more insights on why he thinks that way.
and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood, and to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number one just strikes Charlie and me as madness. And it's conventional practice, and it may, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. I mean,
Sheesh, this guy went hard, right? This guy went hard. That's a pretty strong statements to make, right? This guy's like, hey, if you're going diversified is a strong state. Is basically it's a confession. Like, you want to keep your job, you want to keep it safe, you don't know what you're doing. Now, does that mean you should not diversify? Not necessarily. Not necessarily. And we're going to dive deeper into that as we go forward. But I wanted to play with you. I wanted to play to you at least this so that you see what the best investor of the 20th century had to say about diversification. Now, now, um, summarize it. He's not the only one. He's not the only one who thinks that way. There's also Mark Cuban, who also cash out from one of his companies, sold became a billionaire. Now he's also one of the Shark Tanks investor. And yeah, guys, he thinks the same way. He's saying diversification is for idiots. That's what he's saying. Mr. Warren Buffett is saying in another way, it's a protection against ignorance. I saw this comment earlier when I posted my stream on a forum earlier today. Someone said, if you don't know what you're doing, diversification is for you. And if you do know what you're doing, you should not diversify. We can dive deeper into that towards the end as well. But these are strong statements, and I think this is. I'm going to play the next person who has an entire different perspective, who's also a big name in the investing and financing world, right? And I don't know if you know this guy, but it's Mr. Ray Dalio, right? Let me see. Actually, I was listening to this video earlier today, so yeah, let me rewind it back. But have you anyone in the chat? Have you heard of Ray Dalio before? Let me know in the chat if you have heard Mr. Ray Dalio. So Mr. Ray Dalio is, for those who may not know, is a hedge fund manager. I think he has a very successful hedge fund called Bridgewater, if I'm not mistaken. That's the name. But yeah, very successful. He wasn't always successful. He was ridiculed earlier because he had a great. I mean, he has a prediction that they never happened, and he had pretty bold prediction early in his career, and basically that traumatized him. That traumatized him because he was so sure that his prediction was going to happen, and when it didn't happen, then he's like, it became traumatized in a way, but that also helped him figure out a strategy to never be wrong again, right? And that's where he started the Bridgewater hedge fund. And now the Bridgewater hedge fund, if it's not the best successful hedge fund in the world, it's one of the top three. But from memory, I think it's the best one in the world right now, as of now, from memory. Very successful hedge fund. And this hedge fund is all based on his principle, what he learned on his journey, how he had to change his mindset when he was so sure that everything was going to happen and it didn't happen anymore. And then he had to restructure his mindset, and the way that he approached investing, to all the way to now that he rise up the ranks of being one of the most successful investors also in the 20th century, right? So now we have two heavy heads, right? Two big names in the investing world with different perspectives. And I love it. I love things like this because now we can understand, we can see different perspective and evaluate that and have a deeper understanding about that main question I asked earlier. Should you be diversified, right? So let me put it back and let's hear what Ray Dalio have to say.
No, I'm big on diversification.
You're very big on
It's
diversification.
Like, knowing how to diversify well is more important than almost anything. People don't understand this.
Is that an evergreen principle, you think?
Yes, that's an evergreen principle.
Interesting.
And the reason I'm saying that, the way it is, it's almost like a casino making its money.
Now, just for guys who don't know, or women who don't know, anyone who doesn't know, it's evergreen. There's a plant. It's a name that derives from a plant. There is this plant that always stay green regardless of the season, right? So they call it evergreen. But now YouTubers loves to use this term as creating evergreen content. Like for example, this content that I'm creating right now, I'm trying to apply the evergreen philosophy. And it means it doesn't matter what time it is. If you watch that video 2 years, 3 years down the line, it still will be relatable. It still will be something that you can factor in your decision making, for example. So evergreen, so that you do the work once, you don't have to redo the work all over again. That's where the principle of evergreen comes in the 21st century, right? So that's what he meant by when you were asking the question, hey, is diversification kind of like this evergreen strategy? And he's like, yeah, sure. So let's see what else he has to say any further. Let me play this. It seems that it's slow today, but let's
Okay.
we'll
Okay.
we'll struggle
The
streaming, but
way
we'll
it
get
is,
there.
it's almost like a casino making its money.
Okay.
Understand that?
Is that an evergreen principle, you
Yes,
think?
that's an evergreen principle.
Interesting.
And the reason I'm saying that, the way it is, it's almost like a casino making its money.
Okay.
Okay. The way that you do it is you get an edge. So now when you have to make a bet, I've got to bet against the whole world. The world has view on something is reflected in the price. So when I think something is attractive or unattractive, that means I have to bet against the whole world and whether that's right or not. That's difficult. I get it right, more often than I get it wrong, but I'm going to get it wrong sometimes. And so when you can take a lot of different bets, what you can do is like the casino, you'll get your average that your bet would be, but you'll reduce your risk of one of those tables not being the table that's paying off. And so that margin, so I can reduce my risk without reducing my return by knowing how to diversify. And I'd say that's particularly important for the people who are listening, your investors.
All right. There's a lot that he mentioned here that we need to break down, but so far, totally different perspective. First, you had Warren Buffett who was saying, hey, it does not make sense if you have 50 different investing, like stocks, for example, in your portfolio, and then you try to put some money in stocks 39, and then you're not putting money in your first stock, right? The number one stock that you love. It doesn't make sense. If you know what you're doing, right? If you're not ignorant, you know what you're doing, you should allocate more of your cash into those investments, the business that you think are going to do well, right? Mr. Ray Dalio doesn't see it that way. He see it as um, a risk management, right? He's seeing as making a bet, which technically an investment is this type of bet, right? You're making a bet, and then you could be wrong. Now, remember, I was telling you back in the days, this guy was arrogant, right? Actually, I'm very deep in numerology, and I was doing his numerology, and I understand exactly where he came from when he was younger. To be honest with you, I was the same type of guy, but he was very arrogant, and he was sure that his prediction was going to happen. So sure that he went on public television making those bold statements, right? And when it did not happen, his ego took a hit, man. Trust me, I know this type of man. His ego took a hit, and now he structure his philosophy on risk management. You could tell just from the way he's speaking, he's afraid of being wrong. He's afraid of being wrong. So what he's trying to do is trying to make bets and trying to be right most of the time. But there's also something else I think he mentioned. And what he's aiming is aiming that the average gain that he makes on the bets that are successful are basically rising the portfolio. And if he can make that over and over and over again, meaning diversified and being right on all of the or most of the investment that he makes, therefore his portfolio will rise, his hedge fund will be successful and all, right? So very interesting perspective. And let's see if he has more insight that he can drop on that.
because what they've got to,
Reduce risk without reducing return.
that's right.
That's the specialty.
That's right.
Elaborate a little bit more if you don't mind on that. So reducing risk without reducing the return, because a lot of times if I'm reducing the risk, it means my return's also going lower. But you're saying, no, we're reducing it without even reducing the return.
Right.
I mean, that's a high-paying skill set to have.
It's
Yeah, that's pretty good to have too, man. If you can keep the same, think of it like a business, guys. Let's say you start a business, right? A commerce, like e-commerce. You buy something for $10, you sell it for $20. And then you've been doing business like that for almost a year. And all of a sudden you figure out that, hey, if you go buy that same thing you're selling, instead of buying it in the States, you go buy it in China, you could buy it at $2 and sell it still for $20, right? So your margin is a lot bigger, but the risk is smaller because now you're not risking $10 anymore, you're risking $2. So that's basically what he's saying. He's saying that, hey, what he figured out is he figured out a way to still get that $20 profit, let's say, without having to invest that initial $10. I'm using business as an example to illustrate what he's saying, but reducing risk by still have the same margin. It's the same in stock or crypto investing as well. And from that perspective, this is something that I do apply in the philosophy because I create my own philosophies. I don't follow necessarily Warren Buffett philosophy, and I don't follow Ray Dalio philosophy. I have my own philosophy, and that's what I'm trying to get at, guys. You need to listen to different people, mix that with your own personality, mix that with your own goals, and create your own strategy, your own philosophy. But the best way you can do that is by learning from people who are successful, that are doing it, and then you can take a little bit of their things and then you mix that with something else and you adapt that in your own situation. So shout out to very quickly, let me go through the chat very quickly. Yes, he said cash is strategy. We're going to get into that, Mr. Peter Investor M. And again, thank you for your for being a member on the channel, man. Never heard of him. Ray Dalio, yes, very successful guy. If possible, I recommend his book, the book that he has on this table right here, Principle. If you don't read it, if you don't like to read just like me, audiobook. You can buy it as an audiobook. You listen to it maybe 2-3 days. These books are must have, guys. You must listen to these books sometimes in your life, especially if you want to be serious about building wealth, about investing. There's so much knowledge and wisdom that this guy puts in his book. It's a must watch. And there's also a 30-minute video that Ray Dalio did, an infographic video on how does the economy works, on YouTube. It's available on YouTube for free. This is a must, absolutely must. What you could watch this 30-minute video and never need to go to school when it comes to economy, right? With Ray Dalio and Mike Maloney, Hidden Secrets of Money, you watch these two videos for free on YouTube, you basically have a bachelor and a master in economy, period. And you need to understand economy if you want to be a great investor, right? Because the bigger scope you can see the bigger trend, then you can adapt your portfolio so that you can ride the wave, right? So not to go aside, try to get a bit. Never heard of it. Fine, I understand, Malika, but yeah, if you want to invest, you want to learn from people who are successful at it, and Ray Dalio is definitely one of the best investors also in the 20th century. All right. Mr. said dead cycle. Yeah, evergreen content. Absolutely. Yes. That's one of the reason I need watches. I believe you are a great content creator because I see your content, and from the beginning they are need evergreen. So you're going to, once you get monetized, you will understand the power of evergreen. All right. I can see I've been monetized basically a week and a half, and I do see, I mean, I'm only getting 1 cent per video right now, but I do see how it can add up long term. And yes, evergreen is definitely the way to go, guys. In my opinion, it is useless to diversify when you have a small capital, but the day you will be able to around 6 figures, you have to diversify. I both agree and disagree with this, but it's not just me. but I see where you're coming from. Let's just say I agree with you 80%. 80% of what you say I agree with. But the six-figure part, this is where I slightly disagree. But hey, man, hey, very good content, and I think towards the end we're going to dive deeper into this content. Thank you for your content here. Money life business. Hey, how are you doing, money life business? I believe I saw you this morning, if I'm not mistaken. So shout out to you. uh, how long did it took to monetize? Well, me, I was on YouTube 2 years, but I really took YouTube seriously last year, making content relatively every week. But I really try to go full time on YouTube on October, and from October to December, I was basically monetized. Um, there is a difference between diversification and asset allocation. Yes, 100% agree with that. 100% agree with that. Now we're going to go back on the content, and let's uh let's have this conversation later, because these are great point, man. You guys are making great point. Salute to my wealth engineers, man. Yes, no worries. I remember. Very good content. Okay, guys, let's get into it, guys. Wait, very quickly, lastly, even the government diversified their sources of means. Oh Lord, Mr. Cashflow Hunter, every day, every comment, you can feel the pain of paying taxes. Man, I wish you could be one of my neighbors, because I bought some lands on the Cayman Islands, and then I'm actually going to have I have a call, guys, tomorrow morning with someone who's a tax strategist, who also some has some good advice on how to save taxes, be an expat. I'm actually considering being an expat right now, because I don't like what's going on in North America right now. And at the same time, as you grow that wealth, you will want to look for ways to keep more of that money. And yeah, so I'll have a free consultation tomorrow. And one of the things I'll be asking him is, does he wants to come here and talk to you guys about what he's working on, and why you might want to consider having a passport in a different country, for example. That could help you save taxes. But hey, well, let's get into it, guys. Let's get into it. I have more things I want to share with you. But very interesting point, guys. Very interesting point. I hope you got it, what he was saying. Basically, find ways to reduce your risk while you still have a high way that you can make that money in your, or have a successful rate um, uh, on your investment, right? Make sure that your investment will be the right bet instead of the wrong bet. Let's hear more on what he has to say.
It's the most important thing that you could start off doing. If you have a number of equally good likely bets, but they're uncorrelated, like the casino, one table is going to make me a margin like this, but take another table and it makes me a margin like this, but I might have volatility about those. Let me take all those investments that I think will make 10%, so that's my return, but they're uncorrelated with each other. That means I'll still get the 10. I don't lower my 10, but my diversification means I lower my risk. So I improve my return to risk ratio.
Is that an art that you can teach?
Oh, yeah. I wrote about it there's what I call a section in this book, the Holy Grail of Investing. It's 3 pages long. And it explains basically this important thing. Because when that epiphany happened to me and how I would do it, it changed everything by being able to do that. Because
how old were you when you figured that out?
I can improve through diversification. I can improve my return to risk ratio by a factor of 5. So by diversifying, the return relative to the risk, I can keep my returns the same and reduce my risk to 1/5 if I know how to diversify well. And that's why I'm explaining it. It's not all that complicated. It's simply explained in the book. But in any case, that is the holy grail of investing. Okay.
All right, guys. That's what you had to say about it. Man, to be honest, it sounds great, especially if you can reduce your risk to 1/5. Because the whole point of investing is don't lose money, right? You don't want to lose money. And the less you risk, the less you lose, right? So the lower your risk, the lower of your chance of losing. So if you could still maintain, for example, consistent 10%, which right now to me 10% is like, really, man? But hey, imagine you had $1 billion and you made consistently 10% on that every year. Now that's some serious money, right? But if you have like $1,000 and you make 10%, right? Really? See what I'm saying? And that is the main point I wanted to bring, guys. That is the main point I wanted to bring. Should you diversify? Should you diversify? It all depends on where you are in your life right now. All depends on your current financial goals, financial situation, right? Your age, maybe. Depends on a lot of things. But that's why I wanted to play the next video, because I've been I mean, I have my own strategy, right? But you always wanted to challenge your own strategy to make sure that you are on the right path, which is something you should do also. If you have one way that you want to do things, don't really be set on stone. Don't put it like a set on stone on it, right? You still need to evaluate it and reflect on it to make sure that it's still the right idea. Because it might be the right idea in 2 years ago and last year, but it might not necessarily be the best idea this year. But if you keep reflecting on it, you'll eventually figure this out. But if you don't, then you'll just committing the same mistakes over and over again. But great point. He was able to reduce his risk by a factor of 5. Lower the risk, still maintain the same amount of investment. Think of it as this way. Again, the same example. Buying something for $10, selling it for 20, right? I basically made 100% return on my investment. Now imagine I reduce my risk to the amount of 5. 10 divided by 5 is $2. So now I have $2 and I'm selling it for 20, right? So now it's not 100% return on my investment anymore. It's 1,000% return on my investment. It's a 10x. It's 10 times my initial investment. So still lower risk and it's still a higher percentage of return. That is good. And he was able to do that by diversifying and have different bets. Now, let's see what this guy has to say about it. Right? Mr. Patrick Bet David. Mr. Patrick Bet David runs a YouTube channel called Valuetainment. I subscribe to it. I've been subscribed to Valuetainment for a long time. One of my OG YouTubers. Before he was a million subscriber, I was subscribed to him. And I still watch his video till this day because there's so much value that he provides. As an entrepreneur, you can learn so much from him. So he's one of the best channel I've saw that really broke it down and it factor both ways of thinking. This way of thinking that you should not diversify, or this way of thinking where maybe you should diversify. And the way he puts it, it really makes you think about your own situation. And he presents a lot of facts, a lot of information. So we're going to watch a lot of this video because there is so much you can learn from it. And after this, I'm going to share with you my own experience. I'm going to share you about my own take when it comes to diversification and some tips as well. Some tips as well of what you can do on how to divert and all that. But let's get into it, guys. Let's get into it.
First, I sent out a tweet saying, I no longer hear any experts claiming cash is trash anymore. What happened? Question mark. That tweet goes out right after 3.28 million people applied for unemployment and right after 6.65 million people applied for unemployment, 10 million people in the month of March. We're at 16 million people in 21 days nowadays.
All right, just to give some context, he published this video the April 14, 2020. So that's kind of like 1 month after the massive lockdown here, right? So I think the numbers that he's talking about, I mean, he wasn't thinking about evergreen content when he when he was recording that, right? Otherwise, there was no need to mention that.
Markets tanked. Everybody wishes they had a little bit more cash. And when I send that tweet out, people started coming back saying, Pat, are you talking about this person? I think he's talking about this person. I think he's talking about Ray Dalio. And then a week after that, Ray Dalio is asked, do you believe cash is still trash? And he says, I believe cash is still trash. Today, I am responding to the concept of, is cash still trash according to Ray Dalio?
Now, is cash is trash? To me, what do I think about it? I think, yes, absolutely. Why? Because simply because the government is printing it, and cash is trash in a way that if you want to save it, it's pointless. It's pointless. To me, if you get cash, you need to spend it somewhere. Either you spend it in something that can multiply your cash, or you just convert it into another asset that will appreciate over time. So from that perspective, it's trash because you want to throw it away as fast as possible. You don't want to keep it and stash it, right? Anyone who's keeping it and stashing it, they're doing it wrong. And it's a matter of time before inflation catch up to them and they realize that, hey, their purchase power is no longer the same, right? From that perspective, it's trash. However, from the perspective of if you have a lot of cash, you have enough money to run your business, right? You can pay your employees. You can make sure you produce even on a market that is going down. From that perspective, cash is king, right? Cash is king because you money. Let's say the market is going up, the market is going down. If you're running a business, you need cash to get it going. You need cash to go buy supplies and make sure you pay anything to make the business run smoothly. So from that perspective, cash is king. So again, should you diversify or should you not? It all depends on many factors, and you have to evaluate those factors as you make your decisions, right? So that's why I'm going to play this video with you guys, and we're going to react to it because he brings a lot of factors that we should think about as we're making that decision.
Question, because the question they're asking maybe doesn't apply to the phase of their life they're currently at. Let me explain to what I mean by this. You know how people ask a billionaire and they say, so what's your current schedule looks like? And he says, I wake up at 7:30 and I go do this. Oh my gosh, I thought you had to sleep 4, 5, 6 hours. You're asking him while he's a billionaire. Why don't you ask him while he was starting up his company, trying to make the whole company work out? What was your schedule then? That's
Yo, you gotta give a shout out to Patrick Bet David, man. This guy is so charismatic and he puts a lot of energy in his videos, and I love it, man. But he makes so much sense, man. That is so true. That is pure facts right here. And many people do that. Many people do that, and they don't factor the road to get there. They're just looking at the road and asking people, and people are a different mindset when they make it there, right? And that's the first thing that he's bringing, which will play a factor to the answer to the question: should you diversify or not? Right? Let's go.
That's the right question. So let me explain to you what I mean by this. In America, when it comes down to net worth, wealth, there's different brackets you fall on. I'm going to talk about some of the ones here. One of them is affluent. In America, if you have $100,000 to $1 million of liquid net worth, you are considered part of the affluent class. If you have $1 million to $5 million of liquid net worth, you're part of the high net worth class. If you have $5 million to $30 million, you're part of the very high net worth, which, by the way, there's 4.795 million of those in America, of which 393,500 of those are specifically.
Bro, look at this, man. There's almost 5 million people that have a high net worth of at least $5 million. And they said liquid. So that means liquid means they can spend that money at any time, right? That money is not stuck in assets that they cannot liquefy, right? Or liquidate. They're just liquid assets. It's almost having that money in the bank or maybe in crypto where you can sell it easy or in stocks or something. But interesting, man. There's a lot of rich people in the States, man. Let's get into it. But I think that's very interesting, by the way. I think he also has a good point. He's going to bring that home.
Just from New York City. And then you have the ultra high net worth, which is somebody that has $30 million to $999 million of liquid net worth. There's only 73,110 of those. 8865 in New York City, that puts you in the 0.003% of America. Let me say it again. Not in the 1%, not in the 10%, not in the 0.1%. You're in the 0.003% of America. Then comes the billionaire class, which you got to have $1 billion.
Yo, G, this is madness, bro. Yo, so we often talk about 1%, the 1% of the world, but he's telling you, man, there is different types of 1%, man, because technically the affluent is still the 1%, right? If you have that much of liquid net worth, you're making more than 100,000, probably making under 300,000 a year to have that liquid net worth in $1 million. So man, that is technically in the 1%, but there is different level to this game, right? Let's get into it.
Or more to be part of that category. So now, when I'm explaining this to you, you may be looking at me saying, Pat, I don't know where you're going with this. What percentage of the clientele that Ray Dalio deals with do you think are just affluent? You think he's dealing with people that don't have $100,000, or you think Ray Dalio is dealing with ultra high net worth, or you think he's dealing with institutional money, running a hedge fund, or you think he's dealing with billionaires? You think he's sitting down with middle American families saying cash is trash? Let me continue here so you get the idea where I'm going. By the way, some fun facts about the ultra high net worth folks. 65% of them are self-made on how they made their money. Out of these ultra high net worth, they average a total of 8 cars they own. That's a study done by Rolls-Royce. 3 out of the 4 ultra high net worth own a jet, and 22% of them made their money in the following industries: finance, insurance, banking, and investment. So now we kind of have a
Yeah. Well, me, I actually want to own a jet one day. So that means I need to be on the ultra high net worth at least. At the very least, I need to be on the ultra high net worth range, which means you need at least $30 million in today's time, right? In today's time, actually in 2020 times, because that's when he recorded that. Since then, whew, lots of inflation is coming. So you need 30 million in at least, which is, yeah, liquid net worth, liquid assets. Whew. And then it can last all the way to 999 million. And then comes the billionaire. Jesus Christ. That's a lot of road to climb, eh? That is a lot of road to climb, but I love the way he puts it, man. And that's a great question. In your opinion, who does Ray Dalio serves? He has a hedge fund, very successful hedge fund. Does he speaks to the 1% that is owned that has 100,000 in liquid net worth? No, not really. For middle America, cash is not trash because they barely have any. Most of us are living paycheck to paycheck, right? Especially the millennials. Millennials are talking about, like, in Canada, we're talking about 70% of millennials are living paycheck to paycheck. There is a study released earlier, not that long ago, not just millennials, the entire America, US thought, the entire US country, saying 56% of Americans are living paycheck to paycheck. 56%. So for these people, is cash trash? Right? For these people, if they wanted to invest, should they diversify? We'll get into it, guys. We'll get into it. But I gotta set the stage. You need to understand the different perspective.
An idea about these different level classes, but where are we going with this? This is one class. Now let's talk about the other class. The other class is household income range. Where am I going with this? Here's where I'm going with this. Less than $20,000 in America income, less than $20,000 of income per year. There's 19.7 million of those. That's considered below or near poverty level. That's nearly 20 million Americans that make less than $20,000 out of your income. Then you have 20 to 44,999. That's 28.7 million of them. That's considered low income. If you're making between 45 to 139.
Guys, I had to pause it here because, again, guys, this is 2020. And the reason why I'm saying this is because in 2021, for those who may not know, The US government printed 40% of the US dollars that are currently in circulation was printed in 2021. So you had 200 years of printing money, and basically the amount of money you printed in 200 years, 40% of that you printed in 1 year. You know what that's going to do for inflation, right? Now going back to this, low income before this happened in 2020 was still considered 45,000 US dollars. 45,000, between 20,000 and 45,000 dollars, that was considered low income. Guess what the average income of the American is? 45,000. That's the average income of the American. So what does that say? Many people in low income or middle class are making average salary. And the average salary is technically a low income. And when you factor what inflation is going to do to them, they're actually they will be well into this low income because the price of everything will rise and their income is not rising at the same rate as the prices. So maybe 5 years ago, that was middle class, but now it is definitely low income. Again, is cash trash to them? Should they diversify? We'll get into that, guys. But I wanted to pause it and talk to you about that because many people fall between this line right here, between the 40 and 40, between 40 and 50,000. That's the average salary of the United States. And not just United States, same thing in Canada, guys. Let's get into it.
That's 57 million of them. That's considered middle class. You're middle class if you're making 139 per year, 140 to 149, there's 2.6 million. That's part of the upper middle class. 150 to 199 is high income. And last but not least, those of you that make $200,000+ per year, which there's 9.9 million of you, you're officially in the highest tax bracket. So remember, so far we've looked at two different things. You got wealth, liquid net worth, and then you have income going from below poverty level to those that are at the highest tax bracket. So where am I going with this? Cash is trash. You think cash is trash to this community? Maybe yes. You think cash is trash to this community? Maybe no. Cash is king here. Maybe cash is trash when you're an ultra high net worth. And that's probably the people that Ray Dalio is speaking to the most. So does that apply to majority of America? Probably not. Maybe to the 0.003% of America. So some of you guys are watching saying, oh my gosh, I have cash. I should get rid of it because such and such person said cash is not good. Let me go a little bit deeper to validate my argument for you. You ready for this? They did a study to see different levels.
Man, so far this guy is dropping games, bro. And that's what I'm telling you, man. This channel is a wealth of knowledge. I've learned so much from this channel. If you are not subscribed to Valuetainment yet, man, make sure you subscribe to that. Maybe after the stream, don't leave yet. But Pat David from Valuetainment, this guy, man, very charismatic guys, very entertaining, and he drops knowledge. He's been dropping knowledge like that, guys, for years. But he's speaking facts, guys. He's speaking facts. But now he's talking more about trash and like cash, cash and trash. But there is a reason why I'm sharing this video, guys. Let's play into it.
Levels of assets that people have from $10,000 all the way down to $1 billion, what percentage goes into which asset? Let me go a little deeper. It's people that have $10,000, people that have $100,000, $1 million, $10 million, $100 million, and $1 billion. Then the assets they looked at were the following: liquid, primary residence, vehicles, retirement or an IRA, life insurance, mutual funds, stocks, fixed income, managed assets, maybe in a trust, real estate, and business interest. When they looked at these different categories, here's a conclusion they came up with. If you look at the screen, you will get an idea based on the color differences of where that money is going to. At the lowest level, with people that only have $10,000, notice how the biggest percentage of their assets are in liquid cash. Do you notice that? And notice how the second level of $100,000, the biggest percentage becomes their primary residence. And then it gets lower because most people with $10,000, they typically cannot afford to buy a house. And those with $100,000 typically own a residence. And then when you go to $1 million, most people's net worth is not tied to their residence. And then all the way down to $1 billion. If you look at it closely, you will notice the wealthier have the biggest chunk of their wealth tied to business interest. Let me say this again. The wealthier, the biggest chunk of their assets is tied to business interest. Merrill Lynch did a study with 800 ultra high net worth individuals to see how.
Man, I hope you are listening, man. I don't know if you watched this video before, but if you haven't, that's why I'm playing it. Because there's so much knowledge in this, man. And and it's so important in the conversation we're going to have today. It's so important. We're going to have today. But man, I wanted to let's go back. Let's go back here. What did I say, guys? Oh, sorry. Let me put it back to you guys. Oh man, struggle streaming already. Slow. Okay, guys, I'll figure it out. I'll figure it out. Now, guys, did you see it? Did you see something interesting in this chart? Because I could make an entire stream on this chart alone. This is very interesting. And you might I remember I asked you earlier, is cash trash? And I said I have different perspective about it. If it comes down to holding it, it's trash. But if it comes down to a business, it's not, right? But hey, if you put that cash, you transition it from here to business, then of course it will increase the business slot and it will decrease your cash allocation, right? And that's what the rich people are doing. So before you even get to the rich net worth, you have to do what the rich people are doing. Me, I actually for house, it's very low. Cash, right now I'm always cash hungry because I put my cash in in business and in stocks and not right now, not stocks and cryptocurrencies, but basically cryptocurrencies and business. That's where pretty much all my cash after my living expenses, that's where all my cash is going right now. I'm trying to replicate something like this, exactly like this. I don't have $1 billion, but if I had to put it for myself, it would resemble that very much. Where in the sense that my cash attribution is very low, my real estate is primary residence is pretty much non-existent, vehicle is very small, right? And if you're talking about what is this life insurance, right now it's very small. I would like to increase that. Mutual funds, non-existence for me. Stocks, very small. And then crypto, it's like big. And then in business, it's actually crypto is way bigger than business for now. But business will slowly get there. And this year, I project that my business and my crypto portfolio will be equal, right? In terms of income and assets that I will have locked into them. So that's basically what I'm trying to replicate, guys. Is that the best strategy? Maybe, maybe not. But eventually, if you make your investment smart enough, you can multiply, right? Remember, I was telling you, business is a way to multiply money. Crypto is a way to multiply money. And the way after you multiply it, you increase that net worth. And that's how you get to maybe to that level. And then you make more aggressive investments, which has more higher rate of returns and go from there. But you could look at this as diversification. But let's say that we were looking at the $1 billion line as a diversification. More than 50% of that line right here is in one sector. So is that truly diversification? Right? Is that the same thing that Ray Dalio was talking about earlier, where you made an equal amount of bets in many things and reduce his risk factor? That's not what most billionaires technically are doing with their wealth, right? Maybe they have different business. Maybe one of them might be in cosmetics. Another one might be in agriculture. Another one might be in retail, Maybe they're diversify in which business that they're doing, but it's still in the same assets class per se because it's still in business. It's not like difference between business and real estate, for example, right? So that's what I'm saying. Should you be diversified? We can talk about that later, but I wanted to show you what the billionaire is doing. And also, you can listen to Pat's David perspective about that. But I think it's on a very interesting breakdown because now you can see how it compares with people. I wouldn't say these people are poor, but there is a clear difference between this and this, right? What most people would have is cash. They would have their real estate. They would barely have any stocks. They would have their vehicle, right? Barely are. Actually, that right there is basically for the upper middle class. It's the same for the um, middle class and poor people. Poor people, they don't need, even have the primary residence, right? But that chart right here can fit a lot of Americans, a lot of Canadians, right? And then zero business for middle class. Zero business interest. Cash doesn't go anywhere there. It's mostly IRA, mostly vehicles, their real estate, and then yeah, some cash. Some of them has zero cash, paycheck to paycheck, and then have these, right? Clear difference between this and this. And if your asset is stock in real estate, and by real estate, I'm not saying it as a real estate as a business, because you could have a business of real estate, which is you buy income making properties, right? You buy commercial real estate, or you buy real estate that you can collect an income from it on a monthly basis. And from that perspective, it's no longer a home. It's not a home anymore. It's not your primary residence anymore. It's a legit business that you can get tax benefit from. You're providing a value for, right? So that's what it is. So that's not what we're looking at here when we see this big red line. This big red line right here, these are people that are using their house as a main, basically a way to do well. Actually, I know someone in my family, many people in my family are doing exactly this. These two lines right here, that's what they're doing. They're buying their property, spending 30 years paying it, and then they're like, oh, okay, if I need some money, I can do like, you take a loan against your house and you still have to pay it, and it's like a never ending thing that you just keep paying. It's not the most efficient way to build wealth. And that's not what the billionaires and millionaires are doing. They're investing in other types of assets, and some of these assets are in business or stocks or crypto or mutual fund and life insurance and all, but less and less and less in real estate. And by real estate, I mean primary residence. If it's not if it's not putting money in your pocket, then it's not an asset. If it's not putting money in your pocket, it's a liability. It may appreciate over time. That's true. But if you're using it as a primary residence and your plan is to stay in it for 30 years, then for 30 years, it's a 30-year liability, not putting money in your pocket. And if you're not diversified, then that's basically your main source of wealth. And that's the main thing between the average person and the billionaires or the millionaires, right? That's the main difference. So I really wanted to show you that strategy here as we're talking about diversification, because it's not just diversification of your portfolio. You got to take off diversification about everything, and then we'll break it down into the portfolio. Because hey, maybe you don't want to diversify. Where? Let me see, mutual fund, right? Maybe you want to diversify in mutual fund, but that could be overall maybe 20% of your entire wealth. And then while you diversify in mutual fund, maybe you can have different types of mutual fund, right? In different sector. So this is diversity. What we're looking at right now is a diversification on a macro scale. And then later we're going to talk about diversification on the micro scale, smaller, right? Perfectly in a niche, talking about niche per niche. And then after, we're going to talk about stock per stock or crypto for crypto. But you got to do the macro work first. And once you understand and you have a clear vision where you want to go, then you go look at specifically at one thing at a time. And later, as you're building your position, it becomes diversified, but not starting with diversification first. That's my takeaway. And I'll tell you that later. We're going to dive deeper later, but at least I wanted to show you guys this. And because I think it's a very important point. And when you factor that with your income, with who you're taking the advice for, who are they serving, right? Is diversification for you or not? Is cash is good for you or not? This is very good point to bring on. So let's play more of that video and then I'll wrap it up, guys. I'll wrap it up with the points I wanted to make.
To business interest. Let me say this again. The wealthier, the biggest chunk of their assets is tied to business interest. Merrill Lynch did a study with 800 ultra high net worth individuals to see how they invested their money and where their assets was. 55% was in stocks, 21% bonds, 15% cash. Once again, 15% cash, 6% alternative investments, and 3% is other. So when you look at this data, you see this here from where their assets are. You see this here where their assets are. Now you see why Ray Dalio is absolutely right, depending on which community he's speaking to. And Ray Dalio's advice doesn't apply to you if you're in a complete different situation. I've never met a venture capitalist or somebody who started a company that sold it for $1 billion or $100 million or even $50 million. I've never met somebody who didn't say the value of cash to have when the tough times come, that cash allows you to survive challenging times. How many startups, the seventh of startups with great ideas.
Yo, that is pure facts right here, man. Pure facts right here. Especially, again, everyone is a genius when the market is going up. But when the market is going down, what can you really do? And managing your cash is important, especially, for example, let's say you lose your job, right? You lose your job, you don't have enough income that's coming in from your job or from the government. Cash is king there because you need it. You need it. If you can manage it, there is there. So from that perspective, he's 100% right. But if we're looking at the way you want to invest it, multiply it, yeah, that's the best takeaway that I take from all that is when you get the cash, save it, invest it, and multiply it as fast as possible. And if you can have that system rolling, you're good.
Great companies, great teams, great founders, great systems. Everything was great. They ran out of cash. How many companies are buried at the cemetery of startups that lack cash? Many of them. Many of them you'll never hear about because they ran out of cash. So the concept of cash has to do with what phase of your life you're in. When somebody says, well, I think Pat is trying to debate Ray Dalio. Here's a man worth $19 billion, writes a book that sells nearly 4 million copies with Simon & Schuster. I had every single one of my executives read his book. I had every single one of my sales associates read his book, over 14,000 agents. I had people write a paper on it because of the way he views things. It's a 600-page book. His philosophies work. He and I sat down together and had an incredible conversation. I don't know how many views the video has. I would say it's shy of 1 million views because it's in depth. This is a man that knows economy and finances, and he has strong opinions about it, but never forget who's his community. The community may not be you. You may be working on getting to a certain level to be an ultra high net worth where, yes, cash is more trash the wealthier you get than when you're coming up. So don't take advice from people based on a phase you are not at yet. Take the advice from the person saying, hey, Mr. Dalio, if I'm at this level, how much cash do you think I need? If I'm starting...
Man, right there. Go check out this video, man. You can check the whole thing later. But man, I wanted to bring this because although he's talking from the perspective of cash is trash, it's the same thing for should you be diversified or not. And when you factor two successful people that we talked about earlier, right? For those who are just joining in, shout out to you. But earlier we were talking about Warren Buffett, one of the probably the best as investor in the world, right? In the 20th century. Then we talk about Ray Dalio. They have two different perspectives publicly when it comes to diversification. Ray Dalio say diversification is one of the way that he uses to reduce his risk. Great point. Maybe you want to reduce your risk. Maybe you want to. Maybe that's a good way to start. But Mr. Warren Buffett says, hey, diversification is, if you don't know what you're doing, then it's probably better for you to diversify. But it's basically a protection against ignorance. If you don't know what you're doing, then yeah, diversification kind of makes sense. But it doesn't really make sense to have 50 different business that you're investing together, and then put money in the business that you're not too sure about, and then leave the type of money, like the business that you're sure about, you're not putting money into it. So that's why diversification to end doesn't make sense. And yeah, great point. But when we talk about should you diversify or not, it comes down to who are you taking the advice from? Where are you in your life? Where are you in your life? What type of income are you making? What are your financial goals? Right? You got to factor all that in and then make a best decision for you. And we're going to talk about that. And I'll share you a story that made me, how I figure it out, the strategy for myself. But before I go there, I want to go quickly on the chat. Sorry, guys, I've been neglecting the chat today. But thank you for your support, guys. Talking about countries where you can get better tax. I got to look into the DR. Eventually, I think for me, all roads will lead there for me. It's closer to Haiti, and I'm Asian. So I think eventually I'll get there. But right now, Cayman Islands is closer to me. So I'll be looking at Cayman Islands for the next 2-3 years for sure. Already got a land there. Started paying the land, so we'll see. Wow. Oh, I think you're reacting to that high net worth individual. These change what I thought of the 1%. Paris Johnson. Absolutely. Yes, man. There is different level of the 1%. It's kind of like an entire new system. Once you get into the 1%, there is such difference between the 0.001% versus 1% that the 1% should not even call themselves 1%. But technically they are, because if you compare the numbers with the population, they are the 1%. But there is a difference. Right? He is an older version of Jose Zinuga. They look at an act the same. I don't know this guy. Maybe I'll check it out. I can tell Jose Zinuga studies him. Maybe. I don't know. I don't know this guy. Maybe I'll check him out. I was thinking of that also. Maybe. I don't know. I'm not sure what it was. Lash's journey. How are you doing? Salute to you. Maybe next week we can connect and make that stream together. I love Patrick. I think that's what you meant. I love Patrick's. Yeah, Patrick Bet David, man. There's so much you can learn from him. That was a powerful statement. Sure. Now, guys, let's talk about that story I was telling you about, because I think there's so much you can learn from it. For those who don't know, not that long ago, I wouldn't say I was poor, but I was really struggling. I started this channel when I was struggling. And actually, my idea about when I started this YouTube channel was, you always see people like Gary Vaynerchuk, Grant Cardone, after they become successful. You never see someone who really had to grind it, struggle their way to success. And what if I could do a channel where I'm going to start my journey because at that time I had already started my journey. I don't know if I'll be successful, but what if I could document everything along the way so that, hey, one day if I am successful, at least the whole strategy, the whole road, you could literally see me doing it. So it's not just me saying it, you can see me doing it. So that's how I started my channel. At first, I kind of started as the personal development business type of channel. Later, I focused more on wealth engineering because I realized, hey, you know what? To be successful, you got to focus on that. You got to focus on being specific on YouTube as well. So, wealth engineering to me is kind of like the best way I can encapsulate everything together. Now, when I started this channel, guys, I was really struggling. But it was at the same time that I developed the philosophy that I called wealth engineering. I teach that on my course. I have a course. The links at some point will be in the description. You can check it out. It's basically technical investor, everything you need to know before you start investing, and how I use the forces that can affect your wealth that you cannot control to my advantage. I master timing, right, and discipline, and that are the forces that I can control. And I can also control where I allocate that cash. Remember, we were talking about cash earlier. Where I do allocate that cash at the right timing, understanding the force that can affect my wealth, then that's how I can replicate success over success over success. The first time I tried this strategy, once I understood everything, just like Mr. Ray Dalio, something happened to him. He learned from it, and then he built his entire strategy that is going to wrap his whole entire life around this strategy, and that's how he created his hedge fund, which is now one of the best hedge fund in the world. For me, it's the same thing. There's a reason also. I'm very deep into numerology, guys, and me and Ray Dalio, we have the same path. We are in the same path when it comes to our life journey. Um, so for me, I was sure about something. I was investing. I was putting a lot of time and energy. It didn't work out. I lost a lot of money. My credit score got hit. I had to do Uber for an entire year just to recover because I didn't want to go back to work. I still wanted to have time to work on my business. So I was a Uber driver working at least 40, 50 hours a week and still working 30 hours on my business at the time, right? So that's the time that I start my YouTube channel. But throughout doing all that, I was also doing that strategy that I was telling you about, the wealth engineering strategy. And I specified it, I did it on one single stock. So, not simply that I chose the right market, I went on a segment like the stock market is huge, right? I went on a penny stocks. And then in the penny stocks, I went in another niche called the hydrogen stocks. There was only three company back then that were in the hydrogen. And it's kind of like this other way of creating energy for electric cars or anything, electricity. So there was this company called F-Cell. I made a video on my YouTube about it, how to take $500 and turn it into $100,000. Well, I'll explain exactly that investment that I made and how I turned $500 into $20,000 in 9 months. I did that video last year, actually. So yes, that's what I did. I was applying everything that I teach, the wealth engineering principle, on one single stock, one single market, one single stock. So when we talk about should you diversify, I was extremely specific. I put all the money I had back then, which was because when I had to start all over again, guys, I started with $500. I had to drive extra times, extra hours, cleaning my car from people that are vomiting in my car from driving Uber. I was driving Uber at night and the weekends. People are partying. I was driving. My back was hurting and driving people to parties away from parties. And some people, man, they're vomiting in your car. So I had to deal with all that, and save $500 because I had a budget for my business and I had to budget my living expenses. So my budget was tight. So if I needed extra money, I had to put more time on my car, meaning I have to factor my gas, I have to factor everything, and then still make $500 extra that I can use. I did that. Did that. And I put that money into F cell. Played it right. 9 months later, that money became $22,000 basically. Then, what did I do? What did I do? I went there and before I say what I do, I really wanted to say this, guys. People, whenever you make a lot of money on a short amount of time, you think you're a genius. You think you're a genius because, hey, no one is doing it. I was able to do it. I must be a genius. But guys, imagine my feeling. Never made that type of money before in my life. I was driving Uber. I don't know what I'm going to do, but what I do know is I tried many different things and I fell in all of them. And throughout my failures, and I was actually going through a depression, and that depression triggered the solution. And since then, I was focusing on implementing that solution, and that's how I created this wealth engineering. It wasn't a logo back then. It wasn't even a name back then, but it was that same philosophy that I'm still applying to this day, the wealth engineering principles. I understood a lot that day when I was going depressed because of my failures. My back was hurting. I know I had to go and drive there. I'm putting so much miles in my car, right? But once I figured it out, I'm like, you know what? I'm going to go out there and I'm going to build that money. $500, boom, 9 months later, $22,000 that I can actually liquid assets. Liquid asset. We were talking about liquid asset earlier. This is my liquid asset. I can sell at any times and do whatever I want with it. $22,000 9 months later. I'm excited, guys. I'm happy. I'm like, this is the way to go. And I feel like a genius. I feel like I can't do anything wrong anymore. Then I had the idea of diversified, right? I was diversifying. And I was diversifying, guys. Some of my bets were going low, some of my bets were going high, but in basically 3 to 6 months, I'm not necessarily making more money and I'm not necessarily losing money. And something happened where the entire market started going well. And then every investment that I made was green. Some of them were 20% up, 30% up. And one of them was 100% up, meaning I made double of what I initially invested. Only to realize, guys, I started with $22,000 and diversified that, only to have 25,000. So everything's going extremely well. And I'm not making that much. I'm less than 30,000. Whereas when I was focusing on one stock and it was going just well enough, I was making a lot of money. And when it was going very well, then right, 10x that money. Actually, I did what I did with that FCell stocks is actually I did a 4x, $500 to $2,000, and then I put that 200,000, $2,000, and I 10x that. That's what I did, by managing the timing. Now I go back and another investment. I diversified. It took me a while to diversify, guys. It took me a lot of work. Now I was looking at every single stocks in my portfolio. I was doing my research. I was reading the balance sheet. I was reading the websites, right? Studying everything to select, should I put this stock there? Yes. I should put this stock there. Yes. I should put this stock. So a lot of work, guys, just to diversify. And then when I'm looking at the results and I'm like, I'm not losing money, but it's not 10x after all this work. And this is what I'm getting? No. And that taught me a huge lesson about diversification. It all depends on where you are in your life. And where am I in my life? Although I made $22,000 and I have that to invest in, I'm not necessarily wealthy enough to get away from diversification. It all depends on where you are in your life. I'm still dependent, very much dependent on my job. At any time, if my job decides to fire me, lay me off, which did happen after, I'm going to go back. I'm going to have to take more risky investments. I'm going to be doing so many things that I did not want to do because I did not build enough money to sustain myself from my investment. So, guys, what is the moral of the story, guys? Before I even get to the moral of the story, I want to talk to you very quickly about how, after I learned this, then I went on. When you understand my philosophy, shout out to the course, Wealth Engineering Technical Investor course, where I talk about the wealth engineering principles. Once I understood that, I went back and I went and chose the right market, depending on the right timing. And at that time, it was crypto. And I made a specific portfolio where I invested close to $20,000. And actually, back then, my bad. I'm talking about a different thing. Back then, when I realized this, $3,000. $3,000. And these $3,000, guys, I put it all in one cryptocurrency. That cryptocurrency did 100% in a bear market. In a bear market, it did 100%. Now I have $6,000. Then that $6,000, I put it into two cryptocurrencies. They both did very well. And then that's how I slowly grow my portfolio, guys, my crypto portfolio to what it is now, where this year it hit $100,000. And let me tell you guys, it did that with only 5 cryptocurrencies. Only 5 cryptocurrencies got me to $100,000 this year. 2021. So what is the moral of the story, guys? Should you diversify or not? We go over it today. It depends on where you are in life. It depends in your situation. It depends on your financial goal. But in my opinion, based on my experience, I can only share with you my experience, right? I'm not a financial advisor. You make your own decisions, but you go figure it out. But based on my experience, guys, and let me look at you in the eyes as I drop this on you. In my opinion, guys, you should not diversify if you're starting your journey. If you're starting your financial journey, you should not diversify. Not only you should be specific, but you should be extremely specific. However, you should spend a lot of time to research and educate yourself on the investment that you're going to make. And when you finally make that that investment, you need to be sure and confident about it, right? But when you do find that investment, you go nuts at it. You load up on that investment and you buy. You wait. So the way I see it, guys, is diversification is putting your money in multiple baskets. You're afraid that these two baskets that you might lose your money into them. At least most of your money is there. It's coming from a fear of losing money. But you're losing money that you don't necessarily have that much anyway. So if you're going to take a risk, my recommendation is, again, it also depends on your age, right? I did mention that earlier. Depends on your financial situation. It depends on your age. But according to me, I'm still in my 30s, right? I can still afford to take some level of risk. When I did this, I was 32, 33, right? So I was early 30s. Now I can take less risk. I don't need to take as much risk anymore. But in my opinion, guys, if you're going to drop this, instead of having multiple baskets and you put your money here, 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 you put most of your money in your best basket. That would be the way I would do it if I had to start all over again. If I had to start all over again, just like I did it with FCell at the time, I repeat it again, at the time, because when you understand what wealth engineering principle is, timing is everything. So at the time, FCell was my best basket. And because it was my best basket and I leveraged time, I was able to turn $500 to $22,000. Okay? I put all the investing money I had back then, into that one single basket. And when I replicate that again in the crypto world at the right time, right? At the right time, I replicate that on one cryptocurrency, then on two, then on three. And as I'm growing my portfolio, I'm slowly going to be diversified. But the first $100,000, guys, that happened in just 5 cryptocurrencies, not 50. And when I say 5 cryptocurrency, guys, 68% of my portfolio was on one cryptocurrency. One, my best basket. So again, should you diversify? In my time, in the where I'm at with my financial goal of buying a private jet and being in the affluent network, we've saw the numbers. That's where I want to be. Diversification is not the way to start for me, because if I start, it will take me centuries before I get there. But if I am not, if I want to get there and I'm focused and I'm multiplying that money and making smarter investment every time it multiplies and respecting the time, then maybe 15, 20 years from now, I might get there. Or I'll try anyway. But that's the way I see it. Eventually, there will be a room for me where I'm going to have to apply exactly what Ray Dalio is saying. I'm going to find ways to keep most of that money and reduce my investments and try to chase that 10%. Remember, 10% of $100 million, guys, is a lot of money. So the result, and that's what I'm noticing too. The more my portfolio increase, the less I'm chasing the percentage, because if you get $100,000 and you make like 5% on that, that's still good money for the month. If you're able to replicate that for the month, perfect. Now, if you're able to do that without selling anything, it's beautiful, right? So that's, at the end of the day, that's what I'm saying, guys. That's my take about it. And while we are this, guys, very quickly, yes, for those who don't know, I do have a Patreon. I started this Patreon a couple of weeks ago. I don't have any members yet, but when it comes to the exclusive Discord, there is about 40 people in the exclusive Discord, and Patreon will give you the same access to that exclusive Discord. And I share a lot of information there, insiders information, news that you may not be aware of before. We try to find investments, stocks, and cryptos, but mostly in cryptocurrency these days, before the masses, right? the right timing for it. We try to get the right timing for it before the masses so that we can make smart investments so that when the masses are acting, we're there to sell it to them, right? That's how I do it. Now, if you don't want to join the Patreon, you're not really that deep in stocks or cryptocurrencies, mostly cryptocurrencies that I do right now, because that's where the best timing is, right? That's where the best timing is, guys. That's why I'm mostly in cryptocurrencies and not stocks. But if you don't want to do that, you can join the. If you want to support the YouTube channel, you can join by clicking the join button. I just launched the YouTube membership program for the wealth engineers. So if there is any way that you want to support, shout out to Game Over with the $2 super sticker. For example, yes, that's one way you can support the channel as well, because all the money that I take on the super chat, I actually reinvested back into equipment, into actually now I'm looking into hiring a team to help me produce more content. So everything that you do will help me produce better content for you guys. So if you're taking any value in the content that I'm making or the time that I'm able to allocate to that, please support the channel. You can click on the join. That's one of many ways you can support. You can support, you do a super sticker, like Game Over, or a super chat, like earlier we had today. But I want to give another shout out to Peter Investor M, the first member of the platform. And I'm looking to have more of you guys to join in, because again, instead of super chatting every so often, you can become a member, and it just becomes automatically that you support the channel. But that's definitely a great way we can do it. With that said, guys, that's what I wanted to break down. We're going to have other points wanted to break in, but I wanted to say very quickly, as of now, Mr. Game Over is the sponsor of the stream, and thank you very much as well. And yes, we always have Mr. Investor M, who's going to be a consistent sponsor of the streams as well. So thank you very much, very appreciated. But let me know, guys. There, do you have any question about what I just said? Was it clear enough for you guys about should you be diversified or not? Right? Because we talk about it. Many people, when they talk about diversification, they talk about it on the micro scale, talking about each stocks, what stocks you should do. Should you be a mutual fund or not? Should you be? This is at the micro level. We got to look at the macro level first, the big picture, where you want to go, and then break it down into the micro level. And that's how I think about it. And that's a lot. It has a lot to do with the way I teach, and yes, and go from there. Shout out to Game Over again, coming up very strong with another $5 super sticker. No words, just loves. Thank you very much. Now you're the official sponsor of the stream. Thank you very much. You have gone with the yeah, the most donation, and I always give shout out to people who donate, and the higher donate, the big donor of the stream becomes the sponsor of the stream. But thank you very much for your super sticker. We truly appreciate it, and I encourage you as well, if you want to join in on the program as well or be a member of wealth engineering, we'll definitely glad to have you there. Shout out to Cash Flow Hunter. Concentration better than diversification. Not always. When you start, absolutely. As you grow, you definitely want to consider diversification so that you can keep some of that money. One of the things I'm starting to do, guys, is I'm starting to take profit from my cryptocurrencies to allocate in business. I'm taking the profit from my cryptocurrencies and I'm buying land in the Cayman Islands. Shout out to Cash Flow Hunter, who loves finding ways to save taxes, right? So, what am I doing when I do that? I'm slowly diversifying, but I'm not just diverse, just like Mr. Peter Investor M mentioned it. There is also a difference between diversification and asset allocation. So what I am doing, although you could say it's diversification, but what it's truly is, it's truly on I'm allocating my assets differently. right? I'm moving it from one asset and allocating it to somewhere else because I want to diversify per se. And if something happens to this market, it's not going to be correlated with this other market. And I want to keep most of my money over time, right? So that's definitely one way I want to allocate that. But yes, there is a difference between asset allocation and diversification. And when we're talking about diversification on a specific market, specific niche, when you start, that's where I agree with Mr. Cashflow Hunter. Concentration is much better. And as you grow, because think of it this way, guys. Let's say you were concentrated, you only have $1 million only, right? $1 million. And you put all that into one single stock. All you have is $1 million to invest. And then you put all that in one single stock, you're taking a huge risk. You're risking everything you have to invest. You're risking $1 million. Now, this could pay very well where if it shoot up and it did 100% on the upside, then you make 2 million. But that's a huge risk because if it goes down and it goes down just 20%, then that's $200,000 that it goes down to. Now, let's say you have to sell it, then you sell it and you automatically lose 200,000, and you're up. You have 800,000 left. You no longer have a million anymore. If you were doing trading and you had your stop loss and your stop loss was at 20%, it's gone. It's gone. Whereas if you diversify per se or allocate assets differently, 200,000 instead of risking it, you actually putting into some uh, income real estate, right? Then maybe you have another one in cryptocurrency, another one in stocks. Now, when you are in stocks, maybe you can be concentrated there. You are concentrated on innovation stocks. And then on cryptocurrencies, you're concentrating in different ways. And then there you concentrated on income property, then that's good, right? You have different assets that are not necessarily correlated, and then you still concentrated in them, which actually lead me to my other points I wanted to mention. But before I get there, I wanted to give another shout out to Mr. Game Over. As I grow, my super chat grow, please help. Hey, it's true. It's true. As I grow, my super chat grows. Yeah, yes, yes, absolutely, man. We'll need that because more content will be needed, more time, and yes, those super chat definitely help because right now YouTube is not necessarily paying much, and it takes a lot of time, guys. It takes a lot of time, lots of research. Man, I'm telling you, right? This year, I'm trying to push YouTube strong so that I can do it full time and not necessarily rely on my job anymore because I love doing YouTube, sharing a lot of knowledge with you guys, especially if you're taking notes, you are participating along the way. Absolutely, guys. What let me give another shout out. I see Stephen Wolf. How are you doing? Still, I hope you're still here. What's up, Chief? Glad to see you doing well. Thank you very much. Yes, yes, we're working hard out here, trying to give that knowledge to everyone here. But yes, guys. But shout out to you, Mr. Game Over, the sponsor of this stream. Now, tips on how you can basically build that portfolio. So, a strategy that I like to think about, guys, is how to be both concentrated and diversified. That's what I like to think about. I'll give you an example. So, let's say you're in a stock market, right? The stock market is wide, it's big. There's so many things you can do in there. Now, one of the segment that is good for long-term growth investment is in innovation, right? Innovation is a great segment in the stock market that you can invest in for long term, because innovation, that's where the future is going. The future is going in the metaverse. The future is going in like automation. So things like that, AI, right? Things like that are great things to invest in. But what if you could find a segment that also pays you a dividend? Remember, guys, one of the main principle of the wealth engineering principle is cash flow value investing. You make money now, and you make money with price appreciation over time. You make money both ways. Cash flow value investing. As a wealth engineer, your goal is to be more efficient. An engineer is someone who designs a system that can replicate over and over and produce results very efficiently, right? And what to us efficient is less energy, less time, more result, right? So in the Nasdaq per se, shout out to Cashflow Hunter, there's a lot of these companies that are in the Nasdaq. That's true. But one of the things we can do, for example, is what if you wanted to be diversified per se, because you're not sure which company, again, you don't have the time to allocate and do the research. So you don't know, innovation is the way to go, right? You do know that, but you don't know which one. So maybe one thing you could do is actually buy a ETF. You could look into an ETF that is in innovation. But what if you could do an ETF that is innovation that is also paying a dividend, right? So from that perspective, what I would want to do if I'm starting is I want to be concentrated on that one single ETF, because by being concentrated in that ETF, I'm building my position, and at the same time, that ETF is made of many different companies in the segment of innovation. And I wouldn't try to go in other segments like utilities, for example, which could also be a great way to start, because utility is safely a stable, fair investment that pays dividend too. If that's where you want to go, stay concentrated in that. But always choose something, one thing that you can allocate your time to. And when I say you want to allocate time to it, 1 year minimum. Build your position so that you can have 10, 20,000 in one position, right? Then when it goes well, guys, goes 10, 20%, 50% up, that 20,000 you invested goes right to 30,000, it goes to 40,000. So it goes very well. So that is the best way that you can be both concentrated, because that is how you get the most return on your investment, especially when you start. That's when you need it the most, right? Regardless of where you are in your life, if you're starting investing, you need to be concentrated to some level, because that's where you need it the most. After you start, you have the momentum, then you start and create other streams of income. But as you start, you can focus on an ETF. That's what I would do if I would start all over again. Again, not financial advice. You do your own research. But I'm just trying to share with you different perspective on what you can do to be both concentrated and diversified. An ETF that's paying a dividend is a beautiful play, but you focus only on that and you build a large position into it. That's what I would do. If you wanted to replicate the same thing in cryptocurrencies, before I go there, I see Cashflow Hunter with REITs. Absolutely. Another way to start, if you're interested in real estate, but you don't have that much capital to start with, REITs is a perfect way to go. It pays high dividends, and you can focus on one REIT. For example, one of the REITs I was looking at was a REIT I was buying, company that was buying commercial real estate, specifically malls, shopping mall. They were buying shopping mall, and they were like, yeah, just collecting shopping mall and then paying a REIT on that. I actually end up stop buying it before the COVID-19 lockdown, because the trend for shopping mall was a lower trend. It was going down. People were going more digital, less retail. So that business model didn't work for me. I transitioned to something else. But at first, I didn't know much, right? I didn't know much. So I was buying REITs, and I was one of the ways I was being concentrated is only buying that REIT and go from there. So that could be another way. But yeah, ETF, I definitely say there is lots of ETF you can look into. I love Vanguard's ETFs, love them. They pay dividends. If you don't know what you want to do, and you don't have the knowledge to really understand the benefit of the business, rely on another organization like ARK Invest, for example. They have great ETFs or Vanguards. You can look into one and then find a dividend paying stocks and load up on that. So I'm saying you load up, you be concentrated on that. But ETFs means electronic traded funds. There is many different companies that are putting that are creating this ETF. It's not just one company, it's a basket of companies. So from that perspective, you'll still have some level of diversification by just concentrating on one single ETF. If I wanted to replicate that in cryptocurrencies, I would do that. And there are some cryptocurrencies that are focusing on ecosystems, right? Ethereum, for example. Ethereum is the ecosystem. There's many different cryptocurrencies that are emerging from this ecosystem. So if you didn't know which cryptocurrencies to go in, well, the Ethereum, it's kind of like the ETF version of the crypto world. Just by buying Ethereum, you're buying a little bit of all of these cryptocurrencies. Me personally, I love Luna as an ecosystem. Why? Because when you go through the principles of what wealth engineering is and everything I teach, there's many things that Luna is doing that is meeting my requirements. So based on my own requirements and my own principle, Luna is doing. But what do I need to do? I need to keep updated to see if this information is still circling back and if that is still accurate over time. Because the minute something happens to the technology or the market that these criteria no longer applies, then I need to know that early on in transition, right? But if you wanted to do that in the crypto world, you would focus on a crypto that is on ecosystem. Now we have Solana as another crypto that is an ecosystem. There's many projects that are done in that ecosystem. Polkadot is another ecosystem. Avalanche, Cosmos. There is one that I'm going to make another video about. Crypto.com is launching its own ecosystem. I'm going to make a video about that. Stay tuned. Make sure you subscribe and click the like button if you want to stay alerted to get more knowledge like that. But Luna right now is one of the things ecosystem that I'm concentrated on. I like the projects that are being developed in Luna, and Luna itself is doing something that I like a lot, that is meeting my requirements and help me manage a lot of things that that meets my requirements when it comes to things that I look into in an investment. All right. So yes, look into that. You're focusing on shout out to you, Mr. Cashflow. I'm focusing on Matic right now at the moment. So Matic would be a specific crypto, right? A great investment, by the way. Great way to start if you want us to stay focused on one thing. I have some inside knowledge about what Matic is doing and what they're planning on doing later. All I gotta say is a good call. A good call. Got nothing against that. All right. So on the cryptocurrencies, if you didn't know exactly what to do, start looking into concentrating on one ecosystem. Ethereum is the ecosystem that there's many projects being done into it. So if you didn't know what to do, just buy Ethereum, right? Or look into another cryptocurrencies that you might like. Then you buy that, and then slowly divert to other cryptocurrencies. Maybe you want to do Matic, maybe you want to do Link, right? Or any other cryptocurrencies out there that you want to look into. Slowly divert yourself, because another thing is, as you learning, guys, in cryptocurrency about cryptocurrencies, as you learning, you could still invest. You could still invest in the ecosystem slash the ETF version of the crypto world. And then now that you have that, you're still invested, then you're looking to see, okay, what is the best single company I should focus on for my next concentration section, right? And then you do that. While it takes you 2 3 months to do the research, you're still buying that cryptocurrency every week or every paycheck. And then when you're ready, you jump at it. That's what I would say. But that's how you could still diversify while you are concentrated, because I think concentration as you start is the best way to play the game, because that's what gives you the most return on your investment. Yes, there is more risk to it, but when you start, you don't have that much to lose in the first place, as opposed to someone who builds 100, 1,000, sorry, 100,000, a million portfolio. Then they have a lot to lose. Then they have to diversify to reduce the risk and then protect the wealth along the way. Because at that point, if you can manage that very well on 4 million, then you can retire for 20 years. If you well diversified and not losing that money is always going to be there for you to fund your lifestyle. So that's where the advantage is. At the end of the day, should you diversify or not, it all depends on your knowledge. For the best investment you can make is to invest in your financial education. Shout out to Mike Maloney. He was the one who coined this term, but it's absolutely true. As you invest in your financial education, you can make some investments. As if you're not sure what to do, shout out to Warren Buffett. He said it. If you're not sure what to do, then yeah, maybe diversification makes sense. But I would say to that is try to find a most efficient way to do diversification. Concentration in something that is already diversified slash ETF or the ecosystem in the crypto world. Shout out to B Nizzle. How are you doing? Hey, I'm trying to set up another stream, a debate going on. I want to invite you for that debate, Mr. B Nizzle. I think you'll provide a lot of knowledge there as well. Shout out to you. Thank you for your comment. So I want to do a debate with the intentional millionaire, Benizel, and maybe I'll reach out to another content creator. I think the Black Man Dojo, but the Black Belt Dojo. I think I want to reach out to all of you guys to have an interesting debate. So I asked the intentional millionaire to reach out to you, Benizel, but I'll remind them later to see if he did that. If not, we'll get into it. Shout out to Before the Billion here with them eyes. Dojo of Manhood. Yes, absolutely. Yes, I want to reach out to him and do the next debate. I love debates, and the intentional millionaire called me out. He asked me to set up the debate. So I got a topic for next debate. Maybe Tuesday. I would like to do it Tuesday. So if you're free, 8 p.m. Eastern Standard Time, we'll make it happen. Be Nizzle. Let me know if you're free in a comment. I'll play it around. But I'll reach out to Dojo of Manhood as well. Shout out to the best moderator online. Please click the like button as you come in. Absolutely, very that absolutely, guys. These are needed, and please share this stream as well. We covered so much gems in this stream, and I hope I was doing research when I was making this stream, guys, and everyone approached this topic on the micro scale, meaning they're looking at it on the stock per stock, on the crypto per crypto. They're not looking at it on the macro scale, right? And the way I love to think about life in general, anything I talk about, even my principle, right, my wealth engineering principle, they all are based on looking at the macro, and then you structure the micro so that you could leverage the macro. A very easy way I can summarize it is, if there are things that you can control, there are things that you cannot control, right? You cannot control the wind, but if you had, like, say, a boat and then a sailing boat, right? You can control which direction you decide to sail. If you are sailing against the wind, you're going to be working very hard. You're going to struggle very hard. But if you understand how to predict where the wind is going to blow, then you can do all the work necessarily to be ready before the wind start blowing. And once it starts, it propels you moving forward, and it can. That's how you can make the most, right? That's how you make the most out of your work, your energy, and that's what I would like to teach you guys, to show you how to see investing on a different perspective. So with this topic, I wanted to bring it down into the macro aspect. The macro aspect, you got to understand your income, your current net worth. You also have to understand where you want to allocate, where you want to go, where you want to go. Me, I told you, I don't know if I'll be a billionaire. I definitely want to be a high net worth and affluent individual. Why? I want a private jet. I want a private jet. So I got to start thinking of, how do I invest which investment do I make so that I can grow my portfolio big enough so that one day I can have a private jet. Maybe it's going to be a super small private jet. Super. I was checking out at Honda Jets, guys. Honda, I don't Honda the car Honda, right? The car company called Honda. They have a segment that creates jets. And yes, man, they have a super small jet, something like almost like a two-seater. It doesn't look expensive compared to your, like, I don't know, your Bombardier, your Gulfstream type of jets. But hey, maybe that's all my money will be able to buy, right? But at least it's something that I can buy, and that's my goal, man. My goal is to be able to buy a private jet and be able to fly around in my own accord, as opposed to be dependent on the airports, the you got the job and all that. So that's where I want to be, man. So what type of investment do I need to make now? And what type of vision I need to have for the future so that I can leverage that, so that maybe 10, 15 years later, my portfolio can get me there, get me to where I want to go, right? So I have to be very efficient. I have to be calculated. I have to look at the most efficient way to grow wealth. So once you understand that, where you are right now, your age, can you handle risk? Right? If you're 60, 65, may not be the best strategy for you because you cannot handle risk at that time. But if you're in your 20s, absolutely you can. If you're living with your parents, you can take some risk. If you're in your 30s, you can take some level of risk, right? So, where you are, which income are you making? Which are you the average man? Are you high income? And from there, you strategize. Again, that's where the wealth engineering principle comes in, guys. So make sure you check out the course. Technical investor course, link will be in the description. If not, guys, check out the Patreon and you can join different tiers. And if you don't want to join the Patreons, you can support the channel in any other ways, whether it's PayPal. Shout out to Gail for putting the links out there, or super chat, or we just launched it, guys. You can join the membership, the YouTube membership. You can join and be a member. Shout out to everyone who will join in. J Bones with the super sticker. Peter Investor M will join the channel and became a member. And Game Over, the current sponsor of this stream, Mr. Game Over. Absolutely, thank you for you guys. With that said, guys, let me go on the chat very quickly before I close the stream. I think we covered everything I wanted to discuss. But yes, guys, you got to think of the macro. You got to think of the macro aspect of investing, and then tailor yourself with that. Tailor the micro action that you take with the bigger picture, with the macro picture, and that's how you make the best of it, right? When it comes to concentration, you need to understand the market, the timing, be disciplined, and stay and put your all your eggs in. I mean, most of your eggs in your best basket, right? Most of your eggs in your best baskets. That's the that's the lesson I've learned from the story I shared earlier in my stream. Now let me go very quickly. Mr. Aaron B said, "Awesome, thank you very much." Uh, Gail at night shared with the link. Wonderful. Oh, I think you're mentioning about the stream. Macroeconomics, absolutely. Go, guys, please go check out Hidden Secret of Money from Mike Maloney. This is a bachelor and master and PhD in macroeconomics. It's a series of 10 videos. I think each of them are about 30 minutes. By the time you get to video 8, guys, you're going to have knowledge that even people with PhD do not have. And it's taught in a way that anyone can understand it. So guys, free on YouTube. Use it while it's still available. You never know. The first module of my course, guys, I broke it down this series very deep. I break it down deep, piece by piece. Everything we need to learn about it, because he's already detailed enough, but we went even more detail and more using real life examples, current recent examples as well, right? So make sure you check it out, guys. Oh yeah, that's the course. Yeah, wealth engineering course. Very successful course from last year. I did pretty good. I only had one person out of 50. I sold over 50 course. Only one person asked for their money back, and I think that person was pretty advanced. So if you are just starting, or if you have been investing in the last 2 years, this course is great for you. If you have a lot of experience, you know exactly what to do, then that course might be a bit too beginner for you. So it may not be the best for you. At that point, you may want to check the Patreon, and I think, and join in on the exclusive Discord. That's where we go a little bit more technical, right? Thank you very much, Paris Johnson. You were following for a while, so I hope you got some good gems about it. And Gail at night, yes, you can also join the Discord on the general chat for free and have a conversation with the members there. We talk about everything, stocks, crypto, share some videos, free videos that are available on YouTube that are teaching us the game. So we all stay connected, guys, and we try to learn together as we are on this journey to financial independence, guys. All right, so with that said, guys, thank you very much for your time. We'll stay connected. I'll try to reach out to Benizul and the Intentional Millionaire for another stream early, maybe Tuesday this week. So we'll have an interesting debate. The subject I want to talk about is should you pay off your debt? Should you prioritize paying off your debt? What do you think, guys? Do you think that's going to create an interesting debate? Is that even a debate? Should we even debate that, right? Is the answer obvious? Is it obvious? Or should we debate that? So I'm going to be actually debating that with I'll try to approach content creators that are willing to join the panel and talk about it. With that said, guys, thank you very much for your time. And until next time, we'll meet on the next episode.
JC, bring that fire, mentally taking you higher. Get the cash flow that you desire, building that wealth. I should call you sire. You about to run it, I know it. We steady growing. This is the moment. You gotta subscribe, cause you don't wanna miss it. Wealth engineering, it's time to get it. Wealth engineering, stacking and stacking it up. It's time to generate wealth till you living like Scrooge McDuck. Hey, wealth engineering. It's time to show you the game till you living like Richie Rich, till you ballin' like Bruce Wayne. Hey.